Good evening. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Wednesday, February 23rd, the year of our Lord 2022. And it is Wednesday. It's Crypto Wednesday. I know we usually do Crypto Tuesday, but there's some story I wanted to talk about today. I didn't want to wait till Tuesday to bring it. Lots happens now with crypto, so probably wouldn't get to it. And it's tax season. And that's why we're going to do Crypto Wednesday today. Won't you join us? Okay, well, as I mentioned, we're going to talk about crypto and taxes. It is today's Tax Talk. It's a tax show. And whenever I can mix the IRS along with crypto, well, that's a double bonus. So that's what we're going to talk about today. I also have a story, if I can get to it, because this story that I want to talk about crypto is a fairly long story. The other story I want to talk about is the ID.me. We talked about facial recognition. The IRS came out and said that they were going to require it, and then they said they were scrapping the whole thing, and now they came out and said something else. And so if we can get to it, I hope we can. Then we'll talk about that a little bit too. So let's get to it so we can cover all that needs to be covered. So let's do that. Okay. It keeps doing that. Wonder why that is. There we go. Go back down. There we go. Okay, so this is a story in Forbes. Forbes has a very good tax coverage. This young lady, Ms. Keck, I do not know her, but this is a very good story. I've read other stories that she's had. And so how the IRS is looking for its share of cryptocurrency and NFT growth. Let's be honest, most tax accountants would not be described as hip, and many struggle to be considered tech savvy. Well, we all know that's not me. I am hip and tech savvy. So although I am not a tax accountant, I am a tax attorney. Totally different thing. Even so, some of their clients' needs are forcing them into a new world surrounding exchange of digital assets. While many persons trading cryptocurrency or buying the non-fungible token think they are just doing something new, fun, or just goofing around because they have the cash to play with, what they don't realize is that Uncle Sam is looking to collect their share. The number of questions being asked in this space have skyrocketed. Countless persons are looking for help and are shocked when they learned of their potential tax bills. The lack of understanding and proper planning in this space can result in significant check being made out to the IRS. If you are one of those persons that is thinking, not again, this is just a fad, it might be time to rethink that attitude. The crypto market capitalization, calculated by multiplying the price of the cryptocurrency with the number of coins in circulation, went over $1 trillion in 2021. A large portion of that market capitalization relates to non-fungible tokens. NFT sales volume totaled $24.9 billion, of which $4.8 billion was related to NFT gaming. That's a subject I haven't really gotten much into. I know they are selling characters, NFT characters, so they're all original. I'll have to look into that a little bit more. I don't know enough I'm not much of a gamer any longer. Was many years ago, but first perspective, crypto market capitalization in 2020 was $750 billion, and the total sales in the NFT market in 2020 was just $340 million. But is the IRS really watching this? The short answer is yes. As early as 2016, the IRS utilized a John Doe summons to Coinbase, which is a secure online platform for buying, selling, transferring, and storing cryptocurrency. The summons requested transaction activity for Coinbase users from 13 to 15 who were U.S. persons. Coinbase was required to provide user information who bought, sold, sent, or received cryptocurrency of at least $20,000 in value in 1 year. Wow, I believe that standard is now $600. Based off the, or maybe it's zero because it doesn't matter how many dollars it is with the brokers, I believe. Based off that information received, the IRS sent 10,000 compliance letters to taxpayers advising them of their failure to properly report to cryptocurrency transactions. In 2021, the IRS issued a John Doe summons to Payward Ventures and the Internet Financial, seeking similar information for taxable years 16 through 20. In March of 2021, the IRS launched Operation Hidden Treasure, an enforcement initiative for tax violations related to cryptocurrency. And maybe you haven't noticed, but there has been a question on the individual income tax return since 2016 regarding this topic, which for 21 asks, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any cryptocurrency? I like that this keeps coming up. I keep showing. I should have had it again today. I show sometimes that it's on the front page of the 1040, right underneath your name and everything. It's the first question asked on your 1040 tax return now. This question that we just read. So if your client says the IRS will never track their virtual currency activity, think again. Like they'll never know about your foreign investment accounts either, and now they do. Tax professionals are not only battling the murky guidance issued by the Internal Revenue Service in this space, but also struggle to understand what all the terminology means when dealing with digital assets. It is merging of the two worlds. The young CPAs who have just started to learn about tax law but are more likely to trade virtual currency and purchase NFTs, coupled with the dinosaur CPA who thinks a hard fork is something you eat with. We know better than that. You get the point. The first step in minimizing unnecessary tax burdens in the digital asset space is to understand the basics surrounding the virtual currency and NFTs. Virtual currency is a digital representation of value that functions as a medium of exchange. Cryptocurrency, I know it seems like we repeat a lot of this stuff every day, but for those who miss some days, and also the repetition is not a bad thing, because you got to get to what this stuff means, what it is. Cryptocurrency is a type of virtual currency that uses a blockchain to validate and secure transactions. Blockchain is a system of recording information in a way that makes it difficult or impossible to change. A blockchain is essentially a digital general ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Why do you need to use a blockchain? Because there is no regulation by the Federal Reserve Board over these transactions. Instead, the community uses validation and consensus to ensure that transactions are legal and determine the ordering of events. The ability to perform validation and consensus is done by miners, requiring energy to run the machines and ability to understand algorithms. In late 2021, the United States became the #1 destination for Bitcoin miners, eclipsing China for the first time in history. Well, China outlawed it last year. That might be why we've eclipsed them. They're still miners in China, but again, it's illegal in China, and they are really cracking down on it. But the vast majority of people involved in virtual currency are not miners. Instead, most people involved are purchasing cryptocurrency such as Bitcoin, Ethereum, Tether, and others. And I again guarantee that you have some clients who are involved in cryptocurrency, and ignoring their investment or not asking the right questions is not the answer. Every cryptocurrency is unique, but for this discussion, let's focus on the two most popular, Bitcoin and Ethereum. To explore the differences, Bitcoin BTC is the original cryptocurrency. It runs on blockchain. Bitcoin supply will never exceed 21 million coins. It is expected that the creation of a new Bitcoin will very unlikely after 2040. I've heard earlier versions of that. Ethereum is also a cryptocurrency, but does not have an overall limit of coins to be dispersed. Ethereum does limit the yearly disbursement to 18 million. One would think that the fact that the supply is not finite would mean that the value would be much less. So what makes Ethereum so special? Ethereum has a blockchain platform. This means that individuals do not only use Ethereum for investment, but with the blockchain platform, they can also create smart contracts. Smart contracts can automatically execute a transaction when prescribed conditions are met. Smart contracts have been used in business cases such as supply chain management, insurance claims, clinical trials, escrows, mortgage systems. The list goes on and on. However, the most popular use of Ethereum smart contract is the creation of NFTs. I think that the NFTs are, again, they're big and they're growing, but the use of smart contracts is going to far eclipse the NFTs, in my opinion. So what are the basic tax consequences of receiving cryptocurrency? The first comments by the IRS in this space came through Notice 2014-21. We've reviewed this notice on this show. You should look back and find it, where they acknowledge the use of virtual currency. The IRS clearly states that for federal tax purposes, virtual currency is treated as property. The IRS also provided that general tax principles applicable to property transactions should also apply to virtual currency. So when your client tells you they acquire some Ethereum, think of it as though they bought property. After your client tells you they have so this sounds like they're trying. So we're not trying to tell investors what it is, trying to tell accountants what it is. Too many accountants don't know what it is, and it can't really help you. That's why I know what it is, and I can help you. Anyway, I'm not trying to sell my services. After your client tells you they have a cryptocurrency, the next question should be how they acquired it. The initial purchase of cryptocurrency with U.S. dollars will not trigger income or gain for the taxpayer. And the IRS clarified in March 2021 that if you purchase cryptocurrency using U.S. dollars, you do not have to check yes in the virtual currency question on your individual tax return. Well, I think the question is so broad you should check yes. My own opinion, because you are signing under penalty of perjury, and that question is very broad, and it doesn't hurt you to say yes. I mean, it doesn't mean you're going to be taxed, but I think to be honest and to avoid a perjury charge, it would make sense to say yes. I don't care what the IRS says. However, if your client receives cryptocurrency as payment for goods or services or mines virtual currency, they will be required to include the fair market value of the virtual currency on the date of receipt in their gross income, and potential self-employment tax may be required. So my client owns virtual currency. Now what? You can use their virtual currency for a variety of transactions. Some might be new to the space and just be holding a cryptocurrency as an investment, like many people, storage of value rather than transactions. Others might exchange their cryptocurrency for other cryptocurrency when they have a hot lead or a good tip. Some use virtual currencies for everyday transactions to pay for goods or services. After all, Starbucks, Home Depot, Overstock, and Microsoft are all accepting some form of cryptocurrency. Your client could also use the virtual currency to buy digital artwork through an NFT or start playing NFT video games. Again, still not sure what that is. The IRS issues FAQs for virtual currency, and we've gone through these FAQs here on this show, which reaffirms the IRS's view that the disposition of virtual currency is a disposition of property, and whether or not the virtual currency is sold for real currency or exchanged for other property, including goods or services or other virtual currency. A capital gain or loss must be reported. Many virtual currency holders overlook this concept. An exchange of one virtual currency for another, a crypto exchange, is considered a taxable event. A taxpayer that disposes of virtual currency will recognize a capital gain or loss that is either short-term or long-term, depending on the holding period of the virtual currency disposed. The gain recognized is determined by subtracting the basis of the virtual currency, what you paid for it, being exchanged from the amount realized, what you sold it for. The amount realized, what you sold it for, in the exchange is either in U.S. dollars received or the fair market value of the property received in U.S. dollars. This basis is the amount the taxpayer originally paid for the virtual currency. Let's assume that Tim purchased one Bitcoin in March 2020 for $5,000. In January 2022, the Bitcoin is worth $38,000. Tim decides to exchange a fraction of his Bitcoin to invest in Ethereum. A token of Ethereum is currently valued at $2,600, and Tim purchases 3. Under the U.S. guidance, the gain would be calculated as follows. So here's I'm not going to go through the numbers, because numbers on podcasts, they don't work well. While you may view this as a simple transaction, there are multiple planning strategies to minimize cash tax impact. The first point to make your clients aware of is that they should aim to hold on to their digital currency for greater than 1 year for more favorable tax. Long-term capital gains are taxed at a lower rate than short-term capital gains. Any gain triggered related to digital currency held longer than 1 year would be taxed at a long-term capital gain rate, subject to a maximum tax rate of 20% versus a short-term capital gain, which maximum rate of 37%. Big difference. In our previous example, that would change the tax due from $1,300 to $2,500 roughly, if it was treated in short-term capital gains. Where many tax accountants get confused is how to calculate the basis and holding period of the virtual currency if more than one is owned. Do they use the first in, first out, FIFO, last in, first out, or highest in and first out methodology? The answer depends on facts and circumstances. That's not very helpful, is it? What's the answer? And here's the answer to most legal questions and most tax questions. It depends. It always depends. The answer depends on facts and circumstances. Through Q39 of its IRS's FAQs for virtual currency, it is very clear that if a taxpayer owns multiple units of virtual currency, they can choose which unit of virtual currency is deemed to be sold or exchanged if the taxpayer can specifically identify which unit or units are involved. What does this allow for? Planning. Provided specific identification can take place, tax accountants can choose to create capital losses or sell certain units of virtual currency to trigger long-term capital gains, depending on the taxpayer's individual tax circumstances. Makes sense. What if your client has hundreds, if not thousands, of cryptocurrency transactions? Don't go it alone. There are a variety of tools out there that can allow taxpayers to link their wallets and produce the gains and losses associated with their transactions for the year. These services will allow the taxpayer to toggle between HIFO, LIFO, FIFO. Don't get too confused about this stuff. This is all, but it can get confusing. That's why you need a good accountant. And not just a compliance accountant. Most CPAs aren't planning for you. They just do they take your numbers and they spit out a tax return. Sometimes you need a planning attorney. That's what we do. We're not too much into the compliance stuff unless there are situations where the compliance makes more sense. And we could talk about that at another time. To see what popular software in this space includes, and I'm not going to get into that. Ticker problems, I'm not going to get into that. Another problem can occur if the digital currency was a gift or was originally purchased on a cold wallet. If a taxpayer received the currency as a gift, they are allowed to utilize the basis of the person who gifted it to them. If they transferred currency from a cold wallet and the cold wallet is not linked to the software, the basis would be improperly recorded as a fair market value of the currency on the date of the transfer. The taxpayer, a cold wallet is one that's not connected to the internet. The taxpayer would be reviewing these summaries. Tax professionals cannot assume they are accurate. The takeaway, it is not always as easy as merely using the report issued by CoinTracker or Coinly and including the calculations in the income tax return. Non-Fungible Tokens, many people became aware of NFTs because of the Christie's auction house sale of digital art of Mike Winkelmann's for $69.3 million. The creation of NFTs has become a social statement and a marketing tool with famous celebrities such as whatever, but they're making millions. But what do they have to do with cryptocurrency? NFTs are created as part of the Ethereum blockchain and are termed non-fungible because each NFT is unique, almost like a collector baseball cards. You generally are unable to purchase an NFT without owning the cryptocurrency Ethereum. While NFTs can be copied and downloaded by anyone, yep, you can copy and download an NFT sold by Christie's right now. Only the person holding the NFT has the true ownership of that work. That's why it doesn't really make any sense to me. You don't have a right to you don't have a copyright either. You just own that NFT. Think of the famous painting Starry Night by Vincent van Gogh. Love that painting. You may have a print of the artwork in your home, but only the Museum of Modern Art owns the original. The other benefit of the Ethereum blockchain for the creators is that the royalty fee can be established within the smart contract. In other words, the original creator can charge a percentage, commonly 10%, of any future sales of the digital work, and it will automatically be deposited in the creator's virtual currency wallet whenever any future sale occurs. Provided any creator's digital work remains popular, the creator could have a royalty income stream for an indefinite period of time, depending on the way the contract was written. NFTs are also being utilized in the gaming space, where a significant amount of growth is expected to occur. The so-called play-to-earn games have been massive boom in the middle of the pandemic because of the many lockdowns. NFTs are used as digital items inside video games and include boxers, weapons, cosmetic skins, and other in-game items owned by specific persons. Inspired by Pokemon, the Axie Infinity NFT game allows players to battle, collect, and build a kingdom for their pets. Yeah, sounds weird. I get it. Players can earn additional digital currency for playing various games, breeding new monsters, and investing in land plots. One of the most popular boxing games is called Crypto Fight Club, where players can fight and collect their winnings. Okay, so we can go on to this, but I wanted to. We're running out of time, and there's still a lot left. Well, there's not that much left, but there's enough. It's suffice that to say, I wanted to touch this other story one just briefly. IRS lets taxpayers opt out of facial recognition. We covered this story when it first came out, covered it again when the IRS backtracked. And now it seems like the IRS is backtracking again. In that the IRS is back to, I should have done that before, but the IRS announced today that a new option in the agency authentication system is now available for taxpayers to sign up to the IRS online accounts without the use of any biometric data, including facial recognition. This is consistent. This is where I had. This is consistent with the IRS's commitment earlier this month to transition away. No, they were scrapping it. They were getting rid of it. They weren't transitioning away from the requirement for taxpayers creating an online account to provide a selfie to a third party to help authenticate their identity. As of Wednesday, let me see where that is. I think it might have been in another story. Here, as of Wednesday, the requirement today, as of today, the requirement for a selfie in a government document still seemed to be in place. I just wanted to do that because we got to hold the IRS accountable, right? They're not doing what they said, which is they were going to, because there was such a big uproar about this. Senators came out, Congress people came out, and they all objected to it. But now the IRS said, "Well, we're not going to do that." Now they're still doing it. So when will they close it? It's and what will they say that they're going to destroy all the biometric data? Is that right? Can we prove that? I don't think we can. Anyway, that's where we are. Thanks so much for joining us here today. Thanks for your indulgence. But again, I think these are important stories, and I think they got to be covered. So I'm going to ask you to, again, like and share our content. We need you to like and share it, get it out there. We appreciate your help. Please do that. Remember, if you're fighting the IRS, the first thing you do when you're fighting the IRS is get a copy of my book, Deal with Your IRS Problem Today. Deal with Your IRS Problem Today. Go to freeirsbook.com, freeirsbook.com. We'll be back here tomorrow for today's Tax Talk, and I hope you join us then. Thank you.